Hey champ, thanks for tuning in. So why do we expect equity investments to earn more than debt? This is a really important and fundamental principle in finance. Understanding this principle can help you make better investing decisions. But let's first define debt and equity. What is debt and what is equity? Let's start with a simple explanation. Imagine you wanted to have a lemon tree. Debt is like an IOU. You borrow a lemon tree from someone else with the promise to pay it back, plus a bit extra for borrowing it. That extra is called interest. Now, instead of borrowing the lemon tree, imagine you and your friend bought a lemon tree together. Equity is sharing ownership of the lemon tree and sharing the profits when you sell some of the lemons. Now let's do a more detailed explanation. So I mentioned earlier, debt is like an IOU. Well, that is essentially a contract between you and another party or person. Paying back with interest is part of the contract, and the lender or the person or party you borrowed from may ask for a deposit or security to protect the principal, the initial amount borrowed. In the lemon tree example, they may ask you to give some cash up front, less than the total amount of lemon tree, to ensure you return it at the specified time. This deposit gives the lender some protection and lowers the risk for them. With equity, since you and your friend own the lemon tree, you now share ownership in the lemon tree and share the profits, but also the losses. When times are good and your lemon tree fruits plenty of lemons to sell, you'll make more than enough money to cover the cost of the initial investment in the lemon tree. However, if your lemon tree doesn't fruit enough lemons, you might make a loss and you'll have to share the loss with your friend. Unlike debt, there's no contractual term to protect you from losses with equity, so there's more inherent risk with equity. But also, when times are good and equity performs well, like when the lemon tree fruits plenty of lemons in the season, the equity owners will gain all the profits, and the debt holders will only receive the interest which was agreed upon at the beginning of the contract. Lending or borrowing money from the bank is a type of debt investment, and buying shares in a business is a type of equity investment. When starting a business, you can choose to borrow money from the bank or finding partners to help fund the business, or a combination of both. When borrowing money from the bank, they have specified terms and conditions they need the business to meet before they will lend any funds. A key assumption for the bank is that the business over time will earn more money from its operations than the interest it will pay for the borrowed funds. They can also ask for other terms, such as a deposit for security to protect the principal borrowed. With equity investors, when looking to invest, since they take on more risk, the business will need to earn more than its expenses and be profitable. One of the expenses is the interest that need to be paid back to the bank. A savvy investor would not invest in a business if it is not expected to turn a profit and earn more than its expenses. Hence, from the bank's perspective, they will not lend money to a business that cannot earn enough profit to meet its interest obligations. And from an equity investor's perspective, they will not invest in a business that cannot make a profit and cover expenses such as interest. So debt has lower risk and lower return. You only expect to receive interest plus the initial principal. When times are tough, you have some contractual terms and conditions which can help protect the principal. However, equity has higher risk and you should have a higher return as compensation. Ownership in the business With ownership in the business, you share in the profits and earn more as the business grows. However, when times are tough, you also share in the losses. Hence why equity investments require a higher level of return to compensate for the higher level of risk compared to debt investments. This fundamental principle is really important because when making an investment, you need to understand what level of risk you're willing to take. If you can take on more risk, you might want to invest in more equity. If you prefer to take less risk, you might want to invest in more debt. You can also invest in a combination of both debt and equity, but favor one more than the other based on your risk tolerances. When making investment decisions, it's really important that you assess your risk tolerance and not just look at the expected returns. With all investments, risk and return are a key principle to consider. But also, understanding why certain investments are riskier than others is crucial, such as the difference between debt and equity investments. This risk and return concept is so fundamentally important to finance that it drives almost all investment decisions around the world. Thank you for your time and attention. I appreciate you tuning in. Until next time, keep being a champ in your investing journey. Cheers.